Hello class, this is Dr. Fenton. In this video, I'm going to work through one of the homework module 5 problems. And so in this one, we see that we have a company that has 3 divisions. Each one is a responsibility center. The company also gives division management a bonus equal to 18% of the excess of actual net income above budgeted net income. This gives us the current year's operating performance right here. So this already has occurred. Now it says that they're planning for the next year, and the president just received next year's budget, and the proposal says 7%, 7% increase in sales revenue, and so forth. But the president looks at this and says, well, we've already have always received like a 12% increase year over year in sales and so forth, at least for the past 5 years. So the president this year says, I'm not going to go with the 7%. I think I'm going to impose a 17% increase. Instead of 17%. So let's see what they're asking us here. Oh, they also say assume that cost of goods sold and selling administrative expenses remain stable in proportion to sales. Okay. Requirement A, prepare a budget income statement based on Atlantic Division's proposed 7%. So what they want to do is take these current year numbers and now prepare a budget based on a 7% increase. It's easy to do. Here's the solution for part A. And what you will do is take each of these current year numbers, each of these, and take each one times 1.07. And that'll give you the 7% increase. If you do that, for example, sales, I'll type it in here on the calculator. The 4,140,000 times 1.07, and that gives you the 4,429,800. Do that for each of these numbers. And when you do that, here is a budget based on a 7% increase above the current year's numbers. Okay. Part B. Do the same thing except you use a 12% growth. So what would a budget look like if it was a 12% growth? Here's the answer. And what you do is take, again, each of these numbers, and now take each of these numbers times 1.12. And that gives you a 12% increase in each of these numbers. So I'm just going to pick the net income number here, 960 times 1.12, and sure enough, it's the 1,075,200. So again, easy to do. Take each of these numbers separately times 1.12 and drop them in this income statement, and there is a budget based on a 12% increase. Now let's look at part B2. Read it closely. If growth is actually 12%, so now we're looking at at the end of the year, and if they see that the growth was actually 12%, how much bonus would the Atlantic Division's executive officers receive if the president had approved the division's proposal? Now the proposal was 7%. So if the budget was based on 7%, but the actual ended up being 12%, what would the bonus be? Now I know here in B1 we prepared a budget based on 12%. Now they're saying, after the year ends, the actual numbers are 12%, but the budget, we go back here, this was the budget that was adopted. What we're going to do is compare the budget net income to the actual. Now we're going to use these numbers as actual, remember, because we're at the end of the year, and they said this was the actual amount. If the net income is $1,075,200, we're going to compare that to the $1,027,200, and here's the answer for requirement B2. And down here shows how to compute it. The actual now at 12%, the net income, minus the budget at 7%, we were $48,000 in net income above the budget. The actual was above the budget. The bonus is based on 18%. 18% of this amount above the budgeted budget, and we have $8,640 as the bonus. Okay, so again, we're comparing actual net income to budget net income, find the difference, take that difference times 18%, That's the bonus. Now let's look at parts C and D. C says, prepare the budgeted income statement based on the 17% increase the president proposed. And the actual results, again, were 12%. What would the bonus be if the budget was 17%, but the actual was only 12%? Well, to prepare a budget based on 17%, let me scroll back down a little bit. Take each of these numbers times 1.17 to show the 17% increase for the budget. These would be the numbers you would receive right here. So sales would be up to this amount, net income $1,123,200. Now if this was the budget, if the president imposed a 17% increase as a budget, but the actual, like it says here, was only 12%, going back to these numbers again, you can see net income here, actual, would be less than the budget, and there would be no bonus. Because remember, it says here, right here, the bonus is equal to 18% of the excess of actual net income over budgeted net income. If there's no excess of actual, this, above this, because the actual is less, there's no bonus. So that's how you work this one. So hopefully that helped you out.